Hey everyone, in this video I'll show you how to easily value a dividend stock using the dividend discount model formula that you are seeing on my screen now. I've already posted videos on how to value stocks with other formulas like Benjamin Graham's intrinsic value formula and with the PE ratio formula, and based on your feedback you all found them really helpful. But if you guys haven't seen those videos yet, I'll link them in the description of this video so you can check them out right after this one. So now without any further ado, let's dive in on the dividend discount model formula. And for this video, we'll be calculating the value of Verizon, which is one of the most popular dividend stocks. And I'll be using Google Sheets, but you guys can follow along in Excel as well. So the formula is going to be on the right side of our screen and our calculations are going to be on the left side. And in the formula, we're going to be calculating for V, which is the intrinsic value or fair value. This basically will help us estimate the true worth of the stock based on expected future dividends. And on top of the formula, we have D1, which is the expected dividend next year. This number will be the projected dividend for next 12 months, assuming it grows at the expected rate. And then in the denominator of the formula, we have K minus G, where K is the required rate of return and G is the dividend growth rate. I'll be telling you more about both of these numbers as we do the calculations, so let's move to this cell and start with the company name. So we'll type company and let's type Verizon here. Next, we'll type ticker. And Verizon goes by VZ on the stock exchange, so we'll type VZ. For the next metric, we're gonna pull the stock price, so I'm gonna type stock price. And you can easily get this number from Google Finance or Yahoo Finance, but I'm gonna pull it automatically by typing =, Google Finance. I'm gonna select the ticker VZ, comma, and then in quotations, I'm gonna type price. And you'll see that the value of Verizon stock as of now is $39.88. The next metric is going to be the forward-looking dividend, which is D1 in our formula. And for this metric, you can either calculate it yourself based on the expected growth, or you can pull the number from Yahoo Finance. And I'll use Yahoo Finance just to keep things simple. I'll type Verizon here, select the VZ, scroll down below the price chart, and I'll see the forward dividend of $2.71 for Verizon. And I think Yahoo Finance takes the last quarterly dividend and multiplies it by 4, which is okay in our case. So now we're back in our template and I'm gonna type $2.71 as the forward-looking dividend for Verizon. And the next metric is gonna be the dividend growth rate, which is the same as G in our formula. And for this projected future growth rate of dividends for Verizon, you can either look online for what analysts are forecasting, or you could also look at Verizon's historical dividend growth rate to try to predict a future one. For this video, I'll be using the historical growth rate to try to predict the future one. So I'm gonna go on Google and type Verizon historical dividend growth rate. And you'll see that based on the summary table here, or when you click on different website links, the average growth rate of dividends each year seems to be about 2%, so we're going to use that number. So let's go back to our template and type 2% for the dividend growth rate. And the last metric that we need will be the discount rate, which is the same as required rate of return, or K in our formula. So I'm going to type K here and close it. And we have the discount rate in our formula to adjust future dividends to present value and discount them based on their risk. And the main reason for that is if you rely on future dividends, you're basically taking some inherent risk and losing opportunities to invest your money into other investments. So you have to account for that risk when valuing a stock. And there are different methods for calculating the discount rate, so you can either do it yourself or search for it online. But I also know that the discount rate should be about 6 to 10% for established companies. And since Verizon has a relatively low beta at 0.42, indicating that the stock is less risky than the overall market, I think using 7% is a reasonable assumption for our simple calculation. So now we should have everything that we need to calculate the intrinsic value. So I'm going to go to this cell and type intrinsic value or fair value. And in the next cell, I'm going to type upside, downside. So for the intrinsic value cell, we're going to use this formula. We're going to start with an equal sign, which matches the equal sign here. First, we'll select the D1, which is the D1 here, 2.71, divided by, in brackets, K, which is 7%, minus G, which is 2%. And we'll get the value of the stock as $54.20. And for the last cell, the upside downside, we'll need to compare the intrinsic value of the stock with the stock's current price. So we'll start with an equal sign. We'll select the $54.20 divided by $39.88 and minus 1. And we get 35.9%, which means that if we buy the stock at $39.88 today, and if we assume that the price should be $54.20 based on our calculations, then there's a 36% upside to buying Verizon today. But keep in mind that the intrinsic value here all depends on the assumptions that we use. If we change 7% discount rate to 8%, we get $45.17. And if we change the dividend growth rate from 2% to 1%, then the stock is overvalued. I'll undo the changes to bring the previous numbers back. And I also want to tell you that no valuation formula, including this one, will ever be perfect in predicting the stock prices on its own. So make sure to use multiple different methods and do a detailed research on the company before you decide to invest in it. So now you know how to use the dividend discount model and this formula when valuing stocks. Thank you guys for watching this video, and I'll see you in the next one.